Hello, welcome to InfoFire, the fireside chat series from Information Matters. InfoFire brings visionaries and experts from diverse domains to share their perspectives on a chosen topic. Each episode is a conversation between an expert and your host. I am Shalini, your host for this series. I am an academic with more than 4 decades of experience in teaching and researching information sciences. I am an entrepreneur too. I founded two educational institutions. The first one was the International School of Information Management, ISIM, at the University of Mysore, the first high school in India in the year 2005 with a seed grant from the Ford Foundation. In 2012, I founded the Myra School of Business with a focus on triple bottom line. In today's episode, I am in conversation with entrepreneur, venture capitalist, and philanthropist Sid Mookerji. The topic of our conversation is venture capital in US and India, synergistic investing. Let me first introduce our guest. Sid Mookerji is the founder and managing partner, Silicon Road Ventures, Atlanta, USA. He is a leader in retail and e-commerce innovation, working with startups and research in this space. The Silicon Road venture that Sid founded in 2019 is based in Atlanta and is a vertical fund exclusively focused on commerce tech. It aims to rebuild the Silk Road for the Silicon era by building the future of commerce. He is associated with the Advanced Technology Development Center, ATDC, a startup incubator at Georgia Tech. He is an entrepreneur in residence at Emory University. Prior to Silicon Road, Mookerji was the global CEO and founder of Software Paradigms International, SPI. SPI, founded by Sid, was an award-winning full-service global technology solutions partner of choice for retailers worldwide, which expanded into 8 countries, serving 350 customers with over 3,000 employees. SPI provided IT services as well as a suite of products solving the omni-channel puzzle for retailers. Significant customers of SPI included Macy's, Walmart, Carrefour, Groupon, and Napa. SPI was acquired by Cognizant Technology Solutions in 2018. Mookerji is a philanthropist who founded the Mookerji Foundation, which gave substantial gift to Georgia Tech in 2016 to establish a retail tech innovation program. In India, the Mookerji Foundation provides food and supplies to multiple schools, orphanages, and healthcare organizations. It also supports and sponsors the organization of the world famous Mysore Dasara procession every year. Sid is the president and charter member of TIE, the Indus Entrepreneur Atlanta. He is a fellow and founding partner, Creative Destruction Lab Atlanta chapter. Sid holds a Bachelor of Engineering honors degree in Electrical and Electronics from BITS Pilani, India, and an MBA from Emory University's Vajaphattana School of Business. It's now time for our chat with Sid Mookerji. Hi Sid, good morning.
Good morning to you.
Welcome to InfoFire, the fireside chat series from Information Matters. We are delighted to have you with us today as our guest to chat on the topic of Silicon Ventures, particularly not Silicon Ventures, I would say, venture capital in US and India, synergistic investing. So you have been a successful entrepreneur and now you are an investor managing the Silicon Road Ventures here in Atlanta. So let me ask you a question. Do entrepreneurs really need venture capital funds or VC to succeed? Because some believe that, the VC thing is a hype and a myth primarily because they fund a few and fewer are successful. So, and there are, few home runs, right? So what is your take on this statement, that it's a hype and a myth, entrepreneurs really do not need VCs.
Yeah. All right. Well, first of all, thank you for having me on the program. It's an honor. And so, I have been a venture capitalist now for the past 3 years. Before that, as you said, I was an entrepreneur myself. What I have learned is that not all businesses are venture backable. So even though probably thousands and hundreds of thousands of businesses are started every day worldwide, a very small fraction of them really qualify to be venture backable businesses. So these are the businesses that are based on a unique concept or some kind of intellectual property patent, some kind of new way of doing business. These are the ones that are capable of scaling really fast. And in order to scale fast, investments have sometimes to be made ahead of getting the revenue, maybe developing a product, maybe getting sales staff, and so on and so forth. And you do need to kind of get outside money rather than just pure cash flow. And those are the kinds of companies that are that really should be looking for venture investments, right? Because with venture and with private equity, you give up equity in exchange for the investment. And as an entrepreneur, I would say that should be your last option, right? I mean, first of all, try to do it with cash you have, maybe from the cash flow of the company. The second, I would go and try to see what I can borrow, right? And in terms of maybe get a loan from a bank or whatever. And only the last option would be to give up equity, because if I am building something that I believe is valuable, why would I give up some portion of it to somebody else as an investor? But in the case of venture-backed businesses, these are businesses which have the potential of maybe growing at 5x, 6x every year, and that's where the investment is needed, and the pie becomes so big over a period of time that to give up some portions of it to VCs and to PE is not a bad thing.
So essentially, venture capital, the risk capital as it is also known as. So you look at the risk, both the venture capitalists look at the risk as well as the entrepreneur, right? That how much they balance in terms of cash flow or even giving up their share of equity and all of that, right?
That's right. It is a science. I mean, even though there are, of course, some subjective elements to making the decision as to whether to make an investment or not, but it's also a science. I mean, you can look at the caliber of the founders. You can look at the specific product which has been built. Look at something called product market fit. Ensure that the market that is being targeted is actually interested in the product and willing to pay, what will be required to make the company eventually successful. These are all things that venture capitalists, VCs look for. And yes, but beyond that, there is definitely an element of risk as well, right? And then when VC money is not for everybody, like you said. And in earlier days, I would say that VC, when the whole ecosystem was being developed, the definition of risk was a little different. People didn't know exactly how to kind of think about returns. But in today's world, it has become a lot more structured. Even then, there are, like you said, out of, say, 10 investments you make, only 2 or 3 will be really, really successful and pay the fund several times over. Most of the rest will either return whatever was invested or maybe even lose value.
I'm glad that you use the word science for VC area, because as an academic, I wouldn't also going by the origin of the VC space itself, the VC industry itself. It's primarily a kind of a nexus between academia, industry, and the government, particularly the regulatory framework, etc. So I would say great ideas generally come from the academia, right? Whether it's a technology or the idea itself. What is your take on that?
No, so I mean, there are 2 parts to this. So essentially, in the real world, in the business world, there are specific business problems that need to be solved. They can be for us as individuals or for corporations of different kinds. And then the way in which the problem is solved can come very often from academia, whether it is in the form of very deep science kind of inventions or technology, or it can come from the business world, right? I mean, a new way of looking at a specific problem. For example, a great example for something like that, where there was no patents involved really, but nevertheless, a new way of business was invented, was Uber, Airbnb. These are all examples of creating what are called marketplaces, which connect providers of a service or product with people that are interested in that service or product. So definitely that is a new way of looking at getting that service. And so that is an example of that. But then there are other examples like a Google, which are based on deep technology and academia combined. Yes.
Yeah, I agree with you that Uber and Airbnb are actually based on the market. I would say tapping the needs or the hidden needs, actually unknown needs of the market. But still, it's the technology, it's the platform in one sense, which made it possible. Maybe that's why one of the main spur, I would say, for the VC space is the technology, right from the very beginning. I mean, in 1946, when it started, why I mentioned about the academia is that the first VC in the US was the American Research and Development Corporation, which was founded by General George Dorio, who is a professor at HBS, and he's considered as the father of VC. And the other thing about ADRC is ADRC first funded the Digital Equipment Corporation, whose success actually kind of spurred the whole, I would say, movement about VCs, right? So generally, it is the technology. I mean, I agree, it is the market needs and all that untapped or hidden requirements of the market. But if you look at the VC space in the last 30, 40 years also, it's primarily the technology, IT tech, particularly, that has been pushing right from Silicon Valley to .com boom to the current scenario. So would you agree with that, or would you say that there are other things which are not actually highlighted?
The main thing my comment to what you just said, Shalini, is that between 1946 and call it the 1995, we were operating in a very different kind of world. Okay. So innovation is needed for the world to go forward, for our business and for our personal lives, of course. And in that period of time, before 1995, maybe roughly, innovation used to happen mostly in large corporate labs, in collaboration, as you said, with government and with academia. Okay. Now the situation has changed irrevocably. I mean, it's not going to go back to the large corporate labs, and innovation is happening with what we call startups. And the reason for that are many. Of course, the ubiquity of the internet, availability of video communication platforms such as Zoom, which we are using, and on and on and on. Cloud computing, just in general, the availability of artificial intelligence, machine learning. So these are all things which have become a lot more commonly available, and therefore almost democratized the whole innovation process, which historically was done in large labs. So basically, the way in which the world thinks about innovation in the 21st century is kind of different from what we thought about innovation when I was going to college, right? Where you had to go to a large laboratory either run by the government or by a large corporation to really create any kind of innovation. So that's the main difference. But other than that, I pretty much agree with what you said.
Yeah. Now, I mean, you rightly put it as democratization of, you would say innovation primarily due to the access to technology, right? So access to technology to everyone now they could do whatever they want with technology, particularly if you have the great idea. Perhaps I think even though it's still technology, the democratization of technology to almost everyone with the necessary skills and knowledge has made the big difference. Now, we've been talking generally about, I would say, even the world scenario, it's primarily US based. Now, coming to India, it's been quite late. Only in the 1980s, the so called VC space emerged, primarily triggered by the government policy shifts and, regulatory framework, right? So, what, according to you, are the necessary factors for a healthy ecosystem for VCs
in India? So in
in
India,
India, and then of course primarily focused on India, and of course in a way it applies to the US as well, right?
right. So there are multiple factors, right? So one, the technology is now available, of course, in India, like it's available anywhere else. To your point, the government regulatory policies have to support uh, early stage companies, small companies, and so on and so forth. Very frankly, that is a work in progress. I think lots of progress has been made in terms of making it easy to do business in India, but it's still not quite there when you compare it to the United States or to other developed countries. But the government, on the other hand, has gone out of its way in supporting startups through various programs. I won't list any here, but there are several programs that the government has introduced to basically provide capital support, right, both to funds, VC funds, as well as to startups. And so that definitely is a positive that doesn't exist anywhere else in the world. The second part about the VC ecosystem to thrive is for founders of startups to understand what it takes to be a venture-backed company. So in other words, most entrepreneurs think about, and especially because of maybe the way Indian culture is, we always think about our startups in terms of how quickly can we make them cash flow positive, right? I mean, we don't want to overspend. We don't want to. Our goal is to say, okay, show me a profit and loss statement, and when will that become green? That's all we are looking for. Now, if you are a venture-backed company, you got to throw that thinking out of the window, right? And you got to say, I need to increase my top line. My unit economics have to be sound, but I have to be able to, increase my top line at, and that becomes the top priority. Bottom line doesn't matter at all. Okay, and that's where venture money comes in to help you grow. And there are many founders in India who are kind of not able to achieve that growth, not because that their technology is poor or whatever else, but because they are not able to think in that manner. They are very risk averse, and that's really what slows down growth. Very frankly, I ran a company for many years, for 25 years, and for the first 22, I never got anything else, any outside investments, and that probably slowed my growth as well. Mine was a very different kind of business. I didn't need a lot of external capital. It was a services business primarily, but I'm just saying that it's just maybe culturally we are averse to having anything other than cash on our balance sheet, no debt, no external equity for sure.
But maybe it has changed now, like, the new entrepreneurs in India too have become. Just to mention, because nowadays everybody says that, just they start something so that they can become rich soon and then sell it off or sell it up. Good that you mentioned earlier that, the risk that people have to think about going to the VC is that you are giving up your share of the ownership, right? Now, that brings me to the question of, what are generally the structures, company structures that VC funded one follow, or have there been changes over the years from the last 30 years, etc.? And also the differences between US and India when it comes to typical structures of companies funded by VCs.
Yeah. The biggest thing that VCs look for is a corporation which does not have pass-through tax in terms of structure. So in the US, there's the LLC structure, limited liability corporation, which can operate like what is called an S corporation. In other words, all the profit or loss of the company flows through to the shareholders. Okay, as opposed to what is called a C corp, and a C corp is allowed to retain the earnings, and none of that is really passed on to investors. So venture is not interested in returns which are based out of profit. Venture is interested only in the returns which happens when they give up their equity to somebody else at a higher valuation, hopefully. So that's really what venture is looking for. So the one thing that our fund and all funds in the US ask for is a C corp, and preferably in Delaware. And the reason why it's Delaware is because Delaware has very shareholder friendly structures. So a Delaware C corp is what we are looking for. India has the same kinds of considerations. The flow through structures have not really taken a lot of hold yet anyway, so it doesn't matter. And also India is a lot more federal in the way company structures work, so it doesn't matter which state you are in. So India doesn't have that kind of an issue. In terms of the way in which investments are made by VC can be in various forms. The most obvious one is, money in exchange for share of the equity. So if a company is valued at $20 million and my fund invests $2 million, I own 10% of the company. So that's the very straightforward thing. It's called a priced round, right? So there are multiple rounds in which startups are expected to raise money, because as they grow, their need for cash for growth, for building the product, as well as for sales and marketing can increase. So that's one piece, though. So the price round is one, but in some cases, there are also what are called convertible notes, in which case, the venture fund provides capital to the company with the expectation that at the next price round, they will be converted into equity with a prior agreed upon cap of the valuation. So I might, in this case, in the example that I gave you, I might invest $2 million, and I might say that the maximum valuation is going to be $20 million. Okay. So in case the company is able to get to a $30 or $40 million valuation, I as a VC benefit from that straight away. Right. So I am allotted 10% of the shares as though the valuation was $20 million. Right. So there is that. There are other things like discounts and all that which can happen if the valuation is below the cap. And then finally, there are several other structures as well. For example, a SAFE structure, which was introduced by Y Combinator. It's a simple. In fact, SAFE stands for Simple Agreement for Future Equity, is what SAFE stands for, and it's a much more founder-friendly structure, which VCs, including ours, don't prefer.
Okay. Since you mentioned about valuation, I was remembering, and also about India. Recently, there was this, tweet by, I think, Kiran Majumdar Shah about, Byju's. You must have heard about the Byju's, and its valuation is in some 22 or 32 billions, whereas its revenue is still in, some millions, right? So what is the, I have sort of, heard or read comments by well-known entrepreneurs, not like academics like me, but entrepreneurs, industry people, that they don't understand this valuation at all. When there is, of course, you also mentioned about VCs look for the top line and not the bottom line and all that. So when there is still no profit, and then there is such a huge difference between its revenue and then the valuation. What explains it is the valuation. Yeah.
So the first point is, I'm not going to take specific examples in the sense of use, for example, right? I need to look at that a lot more closely. I have seen the same tweets that you have. I don't invest in India, but with Amazon, for example, they did not have any profits for the first 15 or 20 years, and then now they are one of the most profitable companies in the world. So that's an example of how startups or venture-backed startups are expected to work, right? So, but also we look at, as a VC, as we make investments, we too make investments into companies not with the really super multiples that a Baiju is being invested in, like you said, with a few $1,000,000, $22 billion, that is, 1,000x revenue or whatever it might be. That's not how we want to think about our investments. We are looking at investments, though, where we do provide a multiple of revenue, say maybe 7 to 10x, but we only do it in the case where we can see a growth trajectory which will allow them to grow into that valuation in a very short term. So in many cases, including probably the investors that invested into Baiju's and others, people are looking at the future value of that company. And the value of a company comes not just from EBITDA or from net profit, but also from top line growth, right? As long as, like I said, as long as the unit economics are sound, okay. As in the case of Amazon, the main thing about Amazon's growth was that they said, well, I mean, it was pretty evident from their financials that if they chose to not grow, they would immediately be profitable.
Yeah.
Right. So unit economics have to be sound. But beyond that, you're talking about, okay, now I understand that now, how quickly can they grow their top line? Because the more their top line is, more the potential of the bottom line is of the net profit. And therefore, the potential valuation is going to grow even higher. And people are always going to kind of give a multiple which is more than what the current PE ratios in the public markets are, because they expect that the growth rate will quickly grow them into that position, if that makes sense. So that is typically how venture makes investments. Now, I mean, of course, there have been bad investments made all the time. I mean, most famously recently with WeWork, right? Of course, Adam Newman and SoftBank. And SoftBank has made some very aggressive investments as well. And some of that is coming to haunt them a little bit. But that's the name of the game. I mean, they've also provided tremendous returns to their investors over a period of time, because by making investments exactly like that, right? And those companies had IPOs and so on and so forth. And they were able to give that great return. They will, of course, have a few bad investments as well. And in this case, WeWork happens to be one of them.
So when did actually the VCs establish themselves as an asset class? And what is synergistic investing you wanted to, because you said you are not investing right now in India, but you want to talk about the synergistic investing in the US and India.
Sure. There are two questions here, right? So I'll answer the second question first. So I probably was not probably entirely. It's not entirely accurate that I'm not investing in India at all, because I have made investments into 5 or 6 companies in the past, and as these companies are raising future rounds, and I'm kind of keeping my position in those companies at this moment, right? So my objective is to grow a fund in India also. So that's going to come in the next few months. I'm talking to a few people, and we'll be launching something on the ground. The reason why there is synergies around investing in the US and India is because the fund that I built in the US focuses on what we call commerce tech. So that's all the technologies around fintech, payments, supply chain, logistics, e-commerce, voice commerce, social commerce, AR, VR, and everything that is relevant to retail e-commerce and CPG. Okay, and we have had a lot of success. We are at 560% multiple modeled on invested capital in 2 years. So it's been a really good run for us. Now with us, we want to make this a global fund. I mean, we realize, everybody should realize that as well, that innovation by no means is localized, right? So there are smart people, smart founders all over the world. And if you have capital, you got to go and find those companies. So that's one aspect of it. The other aspect of it is that many of these solutions are global solutions. There are some which are very specific to a particular country or a specific geography, but many of these, especially all the innovation that is happening in things like fintech, have application worldwide, right? Subject to regulatory differences, of course. So it makes a lot of sense to go and find the smartest founders all over the world. And with my roots in India, obviously, that is a natural place for me to go and find and set up shop there. and then provide a bridge as well, allowing those companies to come and invest in, rather move to the US and maybe even seek US customers and connections that we can provide. From an asset class perspective, that's a different question. So your first question, yes, first part of your question was, well, when did VC become an asset class? That's a really, really good question, because for the longest time, I myself didn't know that private equity could be considered to be an asset class. So we all invest in the public markets. Clearly, we invest in municipal bonds and treasuries. We invest in real estate. And that's typically where it stops, right? I mean, if I have a business, obviously a lot of my net worth is tied up in my business. But other than that, I was not really looking at anything else. Okay. Private equity has really emerged as an asset class in the past 20 years. Before that, most people did not invest in private equity. But one of the concepts that is around with investing in public markets is that you invest with what is called perfect information. In other words, the same information about publicly traded companies is available to all investors at the same time. So in many ways, you're kind of competing with others, but you're also going along with whatever happens anyway. With private equity, you have the opportunity to get proprietary deals. So essentially imperfect information. So you are able to kind of invest into companies as long as you're taking that risk, but you have an opportunity to kind of benefit from the growth of a company disproportionate to what other investors might be doing. As long as, again, you understand the specific problem being solved, have confidence in the founders, see the market growth, the traction, and so on and so forth, right? So, and that is for that reason, according to PitchBook, in a 10-year horizon, a 5-year horizon, a 3-year horizon, and a 1-year horizon, private equity, specifically venture, has outperformed all other asset classes. Okay, and the average gain over the past 10 years has been in the high teens. So that's really completely contrary to what many people know or believe in, right? And even today, obviously, people put the majority of their shares or share of their net worth into the public markets more than anything else. And so that is just something that I think will evolve over a period of time, especially as the whole startup ecosystem begins to mature and a better playbook exists in terms of how investments will be made by venture at different stages, and also specialization within venture, which brings the best in a specific industry to the table for investors to participate in.
Yeah, you mentioned about the VC or the whole space being maturing, but in the last decade, it's been a bull run, right, for this venture capital space. And in fact, people have said that 2021 is a banner year and all of those things, right? And that is generally through, a couple of sectors, whether it is fintech or whether it is, a biotech or any one of those, right? So my question is, okay, you have had, when I say you, I meant this VC thing has had a very good run in the last 1 decade, and then 2021, after the pandemic, has also seen a bull run. Now, what is next for the VC? Which sector would you bet on, or what is generally considered as the next thing to happen in the VC space?
Yeah, no, I think that in general, venture and private equity is here to stay. And the reason for that, like I said, is because innovation is moved from the large corporate laboratories to the startups, who, among other things, are also very nimble, a lot more efficient. You have yourself worked for large organizations and the government, and then you did something on your own. It's much easier to buy a simple thing like a laptop, if you belong to a nimble small startup versus, right, working for a large organization, and for good reasons. So I think that is, outperform the startups, and early stage companies will outperform large corporate laboratories for going forward. And so that is here to stay. So in terms of venture backable companies, those will be the companies that are growing disproportionately, and the industries which allow for disproportionate growth compared to what you would see in general in quote unquote business. So if I have a IT services company or a BPO company and all that, Those are the sorts of companies that cannot scale as fast. And the reason for that is because every time I need to get that additional revenue, I need to go and hire new people, right? So the scaling is more difficult. Okay. Whereas with a product, Google or Amazon or so many others, right? I mean, if you think about it, they don't need to hire more people in many cases, right? I mean, their business grows based on the existing infrastructure because it's all on the web and so on and so forth. So I think that any businesses that have that kind of scaling capability, right? Anything which is around technology and are solving specific problems in a unique, innovative manner can see tremendous growth and therefore will be venture backable.
So scale fast is the mantra for the VCs to
That's
fund,
right.
right?
Yeah. I mean,
See, you yourself is, I mean, generally your fund is in the e-commerce space, and then e-commerce, especially in India too, is expected to grow exponentially, primarily because I believe currently it's only 10% of the population which is doing the online shopping, and they expect, given that about 40% of the population has access to internet, phones, smartphones, etc., right? So they see that growth there. So do you expect e-commerce related sector to be the next big thing to happen in the venture capital space?
Oh, no, absolutely. I mean, our expectation of how we want to shop has changed tremendously in the past 20 years. So it used to be that, we would go to a physical store and pray and hope that what we are looking for is there. If not, we would beg the shopkeeper to bring it back, bring it to the store so we could go back next week and buy it. Now we just look online, right? Look for all the reviews of different products. Might do it on my mobile phone. And then when I want to do more research, do it on my laptop and then go to a store only if they have the product already. If not, I'm not going there. So it's a very, very different world. It's a combination of all the different channels. So it is not going to be exclusively e-commerce, because if I'm buying expensive merchandise of any kind, it can be automobiles, it can be very high quality clothing, it can be purses, it can be all those things, right? I mean, I want to touch and feel it. I want to see if it feels good. Only then I'm going to buy it, right? So, but definitely the impact or the influence of doing the online research should not be minimized. So even though a lot of the eventual commerce will happen in physical locations, definitely every single channel needs to be merged in, and that in turn requires technology in different ways. We are also looking to buy in different ways, right? So especially with COVID, I don't want to go and touch terminals. I don't want to touch merchandise unless I want to actually try it out. And so touchless payments, for example, is one example, would be a growth area. Buy now, pay later is another area which is not being implemented very smoothly, and so on and so forth. So those are areas within just the payment, cryptocurrencies as well.
Crypto.
Right. And supply chain logistics, just last mile logistics is such a painful thing. I mean, we all, in the United States, Peachtree Street in Atlanta is half of it is always shut because, there are all these delivery vehicles which are parked on one lane, as you know, and which is very disruptive. And so there have to be better solutions. So technology
You expect drone technology or the drone delivery to be the next big thing?
It will be one of the big things for sure. Yeah, yeah. So there is that. And then, I mean, just social commerce. I mean, things like how do you sell, if you are an academic, well, I mean, can you start recruiting students on Facebook or on Instagram? I mean, those are all important questions. And I think that impacts every kind of business, every kind of industry, every kind of person whoever wants to interact with others. So these are all factors to kind of think. And these are all areas which will really, really grow really fast, be venture backable, and transform what we are doing.
So, would you your final comments on have we reached a perfect storm of capital, talent, technology, demand, all of that right now for the VCs to grow?
No, I think that these are very early days for VC. I think that right now we are kind of looking at the gold rush age of VC. I mean, there's tremendous opportunity A lot more in India than in the United States. In the United States is a lot more mature, but India, I think you'll get outsized returns if you are in VC, or either running a VC fund or investing in VC funds that are run by reputable managers. So these are all absolutely. I think there is tremendous potential in the next 2 or 3 decades for this to really reach maturity to the level that public markets are at right now.
Thank you so much, Sid, for giving me time and efforts to talk to me about the topic that you are passionate about and we want to hear. So thank you so much for this opportunity. From the point of view of understanding the VC space, particularly from an entrepreneur and a venture capital fund manager, it has been a great experience for me. Thank you.
Thank you, Shalini. Appreciate it.